Look, there's no question we're seeing the SP 500 go to record highs nearly every day. That's not to say that investors aren't looking at different ways to build their portfolio. So I think it's really quite interesting. We've just seen our iShares franchise globally tick over 100 billion year to date, and it does align to that number that you mentioned. We have around 70% of our flows into fixed income. And it also aligns a little bit with our views around the government bonds maybe not acting as a ballast. So a majority of those flows is going into investment grade credit and is going into high yield, not so much the treasuries. So it really is a way, I think what we're finding is institutions globally, whether asset managers such as a super fund or whether it's a fund manager, are utilising fixed income ETFs in particular, as a tool to maybe either get liquidity, or maybe they're using it as a tool to tactically trade in a period where obviously things have been volatile. So we believe that this is probably going to, as a trend, it's going to continue. And we'll see that ETFs as a fixed income tool in portfolios only gets greater. Look, I think, when we go back to that point, that our BOI teams, in the situation that we're in, are meeting even more regularly and thinking in different ways than probably they did. And we've seen a massive shift from February through to March and again now around how we're thinking about how to position portfolios. So for example, we used to use a barbell approach, essentially have the overweight equities and utilise government bonds to sort of buffer each other and provide that sort of portfolio access to growth, but also a bit of defensive nature of utilising government bonds. Through the period that was COVID, or through the volatility that that we saw, we shifted that and we moved to actually utilising more credit, so fixed income credit, rather than equities, because there was the ability that we saw that the US Fed was buying up credit in that space, so the ability was there. We know there has been a massive rebound in risk assets. There has been a rebound in equities. The spreads in credit globally have tightened. So again, we've actually shifted again, which normally for us is a very slow-moving process. We don't change our strategic asset allocation that often, but we have in this environment. We've actually gone slightly underweight developed market equities, and we've gone slightly overweight emerging market equities, in particular China. I think there's the growth capacity there. We've moved off government bonds, as we mentioned earlier, and we're now looking at inflation-linked bonds and opportunity. And partly because we really think there's the governments are going to try, once they come out of this period, to possibly let inflation overshoot slightly. If that's the case, well, inflation-linked bonds will serve a great role in a portfolio. And that will probably sort of help you build a portfolio from the perspective of strategic asset allocation. Now that is a very high level view. Obviously there's nuances around how you build a portfolio, but that's where we're thinking the opportunities probably lie.